Anand Tandon is with us. Anand, do you sense that ONGC and the kind of valuation that the buyback is coming at is justified? The fact that it's coming at a premium, of course, the buyback date is on 4th Jan, but it's at 159 thereabouts as opposed to where the stock is currently.
Well, any buyback obviously will be at a premium in a way that it will justify what the government can take out. I mean, the government is under pressure to release money from its own investments, and therefore, among the various options that they have, buying back some of the stock by the companies which are owned by the government is a possibility, and therefore, to the extent that it is a buyback, it doesn't really matter whether it's at a premium or a discount from the rest of the shareholders' point of view. Everybody has an option to actually participate in it. And therefore, it's not something which needs to be frowned on. The number itself really doesn't matter because, as I said, the target is to take some money out.
Right, Anand, there's so much to talk about this afternoon. I want to address the oil story. What are you making of this significant fall, and how much of this can spill over into market sentiment? I'm often asking our guests all day long today, does this give you a deja vu sense from what happened in the early part of 2016? Because we were really surprised by the crash in oil prices, so to speak, then.
Well, certainly it has always been difficult to try and predict where oil will go. But, there are two factors which are affecting oil prices right now. Clearly, one is the whatever happens in the shale oil in the US, and how much of that comes out, because obviously that shifts the consumption pattern very dramatically in the US. For a change, for a while, at least the US was an exporter rather than an importer, and that makes a dramatic difference in the overall demand balance for oil. What is surprising, however, is that in spite of Iran having to cut back and people not buying Iranian oil, this demand-supply gap seems to have completely vanished, which essentially tells you that the economy around the world are not doing necessarily very well. So, to the extent that a lower oil price is not just because of investment outcome, but because of underlying demand and supply, too far a fall in oil prices is not necessarily good for stock markets, because it signals a world economy which is doing far less than it should be.
Okay, but at a time when world markets are looking so weak, and you can just scan through the screen, you'll get a sense on how Asia is closed. Europe is staring down the barrel. The Dow Jones futures is indicating, probably this month's performance alone would have pegged back US markets by nearly 8 to 10%. And that's the worst December performance that they've seen in multiple decades. But our market is still holding out. Does that give you a sense of relief that we are being able to withstand this global sell-off? I don't know for how long, but India's on a relative basis doing okay.
Well, I guess to some extent we fell off a bit earlier. But that said, obviously, if the global sell-off continues, and as you mentioned, what we've seen in the US market doesn't give you much comfort, it is very unlikely that on its own the Indian markets will continue to stand alone, because all said and done, it's not as if we are pegged by some huge earnings growth, or that the valuations are very cheap, or that we are operating in an environment where the valuations can actually go up, at least globally. The only thing going for India right now in the near term is the fact that liquidity is likely to is actually become much better because of the RBI action in terms of buybacks. And the likelihood or a possibility that the interest rates may locally come down. But that can only be at best short-lived, because all said and done, earnings have to come up, and I don't see signs of that at least for the next 6 months.
Right. In light of the decline in crude, Anand, and the fact that aviation names have already run up quite a fair bit from the October lows, do you still believe that one does have an opportunity, given how steady the decline and how consistent the decline in crude has been?
Well, my question is very simple. If you're trying to play crude, why not just play crude? Why bother about airlines? Because airlines themselves have a huge set of other variables which are a lot more unpredictable, including costs and so on, which you don't really know why they are there. besides the fact that the competition in the Indian market is very strong, we heard just yesterday that many of the companies, many of the airlines are having to discount near-term airline fares as opposed to longer-term airline bookings. None of it shows the ability to pass on price increases to the consumer. So I think it's a very cyclical industry, and it beats me as to why any long-term investor would want to look at that sector at all. You want to play oil, just play that. Why bother with taking derivatives?
Okay. What is your call on PSU banks, Anand, after this recap program, or another leash extended out by the government to help the ailing banks?
Well, two kinds of PSU banks. One is the kind of, like SBI, where there's some banking possible and where there is not really that much of an issue in terms of capital, and they have been growing anyway. That's a bank, especially because of the fact that they have huge corporate book, which is what I would be backing right now, is something that you want to have in your portfolio. And that, to my mind, extends to not so much the ownership of the bank as the fact that, the corporate facing banks are the ones that one is bullish on. Now, most of the other PSU banks are also corporate facing, but to my mind, they are not banks, they are donors of money. It's just that it takes them over 10 years to build up a bad enough book so that they go bust, and then every 10-12 years they will have to be funded again. So to the extent that they're trading at so-called below book, if the bank book become real and the government actually puts in some money, you can expect that they will go up and trade at some similar valuation based on the new money. But that's like filling a hole which will get, which will again get dug up all over again. I don't see any substantial change in their ability to evaluate credit risk and to give out loans in a meaningful manner. Nothing has changed there. So all that we are doing is giving them more money so they can go and sink it again. No particular reason why any sane investor should be looking at them other than as a case of cigar butt investing.
Okay, fair point. Stay with us, Anand. Lots more to talk about. But here's Hiren Vaid talking about that consumption will remain the flavor of the market in 2019. That's the word coming in from Alchemy Capital's Hiren Vaid. He also remains bullish in Maruti as well as Bajaj Auto.
Consumers, though, are expensive, and there is no doubt about that. But I think the problem is that people are so have so realized that quality is important in India, and we're not getting the more levers and the Colgates and the Godrejes of the world. So money will go back to these companies.
Auto, staples, durables, what will you buy?
So I think the big beneficiaries are likely to be staples at the absolute bottom end. Durables will also do well because one of the things that Modi promised and what he wanted to do was give 24/7 electricity to the smallest of villages. So if power is available, and if power is available free, I hope not, but if it's available free and if it's available, then people are going to buy consumer durables, because what do you do with the power, right? So that will do well. And autos, I think, are at a cyclical low, which is a secular sector in India, but right now they're going through, a kind of a cyclical slowdown, but it will come back up next year. So all three will make money. Obviously, you have to pick and choose your stocks there.
What do you own?
What do we own?
In that entire theme.
So we own, we do own Maruti. We took a big bet on Bajaj Auto. We think that the new strategy change in Bajaj Auto makes the stock very interesting. Also, I think when markets were trading at 18, 19 times, you had Bajaj Auto trading at 13 times. It's a high quality management, cash in the balance sheet. And I think finally they've realized that they need to start doing something about their market share. And they've started becoming aggressive, started to capture volumes.
Okay, that's the word coming in from Hiren Vaid from Alchemy. Anand, where do you stand when it comes to the entire consumption basket? Because, one often talks about the high valuations, the fact that, even if you look at individual segments like autos, for instance, one has seen that that steady decline in the sales numbers. Maruti had to come out and actually lower their sales target guidance for all of 2018 to 8%. Just yesterday, we heard R.C. Bhargav say that. Would you then believe that maybe for 2019, you need to bet on some other segment? Okay, we seem to have snapped that line with Anand. We'll just get back to him in a second. Some of the movers which are holding out, there's Ujjivan, there's Diwan Housing, IDFC, Equitas. Financials really are having a field day. Kunal, any trading opportunity, be it in Ujjivan, Diwan Housing, IDFC, or even any other financial name that you've spotted?
So I think L&T Finance could be the stock which I would want to trade even at current levels. The setup in terms of price patterns, a gradual breakout, and that too more of trending nature. So the stock was making a pattern of higher high, high lows, and all those highs, all those trading rallies, they were accompanied by a very strong set of volumes, and periods of correction were followed by volumes which were extremely low in that comparison. So the setup in price and volumes is extremely positive for L&T Finance, and the fact that today the stock has, yesterday and today, stock has confirmed a breach of this 200 DMA. I think it just about adds on to that extra level of confidence. So I believe L&T Finance could be a good bet even at current levels, and maybe if the stock provides any dips of say 3 or 4% around this 152 to 150 range.
Anand, we were just discussing about auto space and how people are liking Maruti, Bajaj Auto, to name few. But what exactly is happening in this industry? We are seeing front loading of insurance. We are also seeing, or there is a news flow pertaining to government levying 12,000 rupees per car, so that it's petrol and diesel car are incentivized and EVs are given boost. But where is the EV production?
Well, that's a very good question. Clearly, as usual, they're putting the cart before the horse. Rather than disincentivizing cars, they should be looking to incentivize EVs, and if that means that they reduce the taxes on that, that will go a long way in terms of increasing demand rather than trying to increase the cost on something else. But that's the way it is, and the reality is that the car demand overall is anyway weakening. I don't think that, you've already heard about cutbacks in terms of production and targets being cut back. Clearly, the impact on the NBFC sector is getting through, and as we had anticipated a while back, given the fact that both availability of credit and cost of credit is low and cost is high, it is bound to impact consumption demand in various ways, and I think we are beginning to see some of that happening. So for now, I think auto is a sector that one should be somewhat underweight on till the news flow becomes better, and anything that the government does in terms of increasing taxes will only act to its detriment.
Okay, and Aisha was trying to ask you about what is your take on consumption space? What are you liking there?
Well, I think consumption space is a placeholder right now. It's been the one theme that has worked the best for the last 4 or 5 years, but I think it's now overdone. It both from a point of view of investment thesis, where almost every fund is hugely overweight on consumption for lack of any other opportunity, as well as the valuations where that doesn't leave any play on the upside. So to my mind, we should now be somewhat underweight consumption and bet on the revival of the industrials. Though to my mind, the general euphoria that we are beginning to see in some of the capital goods sector is somewhat misplaced. I think we have yet to see enough capacity utilization in most industries. But that said, I think there is still some upside that may be available on a 2-3 year view on the industrials, and especially in the power sector, etc., where there is a good possibility that, given the fact that we are seeing power sector demand revival happening and many of the issues now slowly getting sorted out, the valuations of the assets are such that many of the utilities, for example, are trading exceedingly cheap, and even the suppliers to the sector are trading at a relatively low valuation. So to my mind, industrials is a better place to be now than the consumers. That said, you cannot get out of it, so you would be somewhat underweight that.
On power space, Anand, the way new governments in different states are waiving farm loans, and now one of the state has seen that even the electricity bills are waived off. I don't know how quickly things would shape up in this space, at least till election. But nevertheless, a point taken that power space would do well. Just a word on market, that Nifty futures are in green or toggling there. Bank Nifty is almost on verge of getting into green, and Nifty is also at the highest point of the day, down by only 8 points. Kunal, this would be frustrating for bearish traders or short sellers of Nifty. Every evening or night they would be seeing that Dow Jones is down by 300-400 points, and they would be happy that yes, now the market would start correcting, and every day we are seeing some gap down opening, but then that gap down opening is bought into. We know that, you know, bullish traders should buy, and you all three are giving buy calls. People who are negative on market, what they should do? Should they just step aside, or should they hedge? What they should do at this point of time?
The point, Siddharth, is absolutely clear that we are into a strong phase of momentum. When you see that surge of momentum, so either it's a momentum which is more of a tipping momentum, where as the principle goes, that the last part of the rise is more steep in nature. So we could be probably going through that phase as well, looking at where the global markets are placed. And if this global correction sort of continues for even one more week, I think then it could have more telling pressure into our markets. So yes, the momentum into our markets as of now is extremely strong. But in such kind of markets, given the global context and given our markets internals, it's difficult to categorize that where the top would form for the indices. You could have another 100-200 points of rally on the index, say in the next couple of days, before actually the kind of correlation, global correlation, gets covered up. But at this point of time, it's very difficult to anticipate a turnaround. Yes, we are into a strong resistance zone, but I think the more important part is to play stock specific and ride this momentum.
Anand, you have to hit the ground running in the coming year with the budget expectations riding high. What, from a policy standpoint, do you think will spill over into investment ideas or trading opportunities in the market?
Well, I think the next budget has to be taken with a pinch of salt because they will have to make announcements in the hope that they don't have to actually execute it, and they don't have the time to execute it. So, whatever the headline statements may be, the reality is that I think the government has shown reasonable attempt at making sure they don't go overboard in terms of fiscal deficit, perhaps somewhat to the detriment of the growth in the economy. And that is a stance that is not likely to change very much, which means that you may have some risk to implementation. So one of the themes that we are actually looking as positive, which is that construction, etc., may actually go up, could certainly suffer because the payment mechanisms could get a bit clogged, given where the government financials are. But, I think you have to look beyond just a budget statement and so on. And as I said, between the valuation and the ownership of consumption, the places that you are left to hide are essentially those which have been beaten down, and where after 6 or 7 years there is some uptick that's possible and there is some sign off in the economy, which is in terms of construction, industrials and so on. And of course the fact that the balance sheet repair of the public sector banks, in particular the corporate facing banks, is continuing. So from that point of view, again, the corporate facing banks are things that they have to do well for the economy, for the markets to do well at all.